This pod is brought to you by RCM's Managed Futures Group. Managed Futures had a comeback year last year with the spike in commodities and inflation talk. And RCM's professional team of advisors helps investors vet and do the due diligence on hundreds of professional managers in the space. Check out everything RCM does at www.rcmalts.com, rcmalts.com. And while you're there, some intel to go with today's pod, focusing on volatility trading. Check out our newly updated VIX and volatility white paper. Just click the education tab, then white papers. Send it.
Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world.
Okay, we are here with Devin Anderson and Zed Francis of Convexitas. Welcome, guys.
Thanks for having us.
Yeah, thanks for being here. My P brain goes immediately to Zed's dead, baby. Zed's dead every time we chat. How long did you get that for after Pulp Fiction came out, Zed?
I mean, how long? It's obviously still a current.
Right.
I think for the entire 36 years of my life, that's been the how I'm introduced to everybody.
I love it. When did that?
Nobody, and by the way, Jeff, no one knows where the name even came from.
Oh, maybe that was it. I don't have my dates aligned correctly. How long?
I was about 8 when that movie came out. But yeah, no, as Devin said, it was our best guess. It's a family name, but then nobody knows where it came from. But our best guess is it's an Ellis Island correction, where it was 12 letters with no vowels from somewhere in middle or
Right.
some Central Eastern Europe, and they're like, nah, America can't do that.
He's the fourth. He's the fourth Zed.
Really? Zed the fourth. Which I would have gone with Zod after Superman 2.
That's a deep cut, dude.
That's a deep cut. And so let's do some quick 5-minute backgrounds on how both of you got into the derivative space, how Convexitas came to be. Who wants to go first? Devin? We'll go alphabetical. Devin gets it on both accounts, first name and last name.
Got it. So I came to the finance world after business school. I'd already had a 10-year career in the technology world where I helped start 2 internet companies, and I also did a stint at Lycos, the search engine. That's
even a deeper cut. Good.
Yeah, 1999 to 2001. So when people talk about the internet bubble, I was there, baby, right on the front line of it. But I went to business school and found the derivatives world there. Then I came out of Carnegie Mellon and spent 15 years at Deutsche Bank in a bunch of different equity derivative related roles. The second to last of which was the head of the solutions business in the Americas, which was everything from fund structuring to exotics to investable indexes to retail structured products. And then actually my last job at Deutsche Bank was in the bad bank, unwinding all that stuff. So I had both the building and disposing of it aspects, which were each interesting in their own right, but. We spent a lot of time in the solutions business talking to the family office, institutional space, and interestingly, I'll let Zed do his background, but a lot of why Convexitas was created was lessons learned from that experience. And what I was slowly figuring out over that period was a lot of the same things that Zed was figuring out, although from a different style of seat. And when it came to an end for us at the equity derivatives, well, really all of equities, Deutsche Bank, we put our heads together and realized that kind of our unique take on how to do the derivative management business maybe made some sense and was unique and a little different than what the world is seeing. So with that, I'll let Zed talk about his background.
And real quick, did you start when you were 8? Like that was a lot of history for a young looking buck. Like
I
yourself.
did. I had to be driven to my first interview with technology. Let's put it that way.
That like us, right? Zed,
I'm much more boring, having an entire career in the financial services space, and Devin can attest. The only thing I'm good at technology is breaking it. That's like
world class.
That side.
World class UAT tester.
But yeah, no, my random walk without, doing too much LinkedIn page is credit sales, PM at long short distress, credit hedge fund, large UK asset manager, boutique derivative overlay manager, and then we got to here at Convexitas. And I would say, what I think is unique about my background, especially when you compare it to call it our vol peers, is that my foundation is definitely in credit. 2/3 of everything I've traded throughout my career has definitely been equity related derivatives and equity vol related derivatives. But all the background of how I think about the world is driven by that fundamental credit view from the foundation of my kind of career. So it gives us, I think, a little bit of a different view of things, having that being the backdrop rather than being equity and equity vol only focused. But as Devin said, to kind of transition into the firm, we've known each other since the start of our financial services careers, especially back in 2007. Devin covered me when I was at that long short distressed hedge fund, we'll call it, one of his first dozen or so clients when he got into that seat. And he's, happily followed me as I moved around different buy side shops throughout my career. But, we've really came to the conclusion that what the world was missing from a correct implementation of just derivative strategy seat is somebody that's very, very tax aware, designs the operational structure within that tax aware wrapper, and then is focused on positive returns rather than sales process, which we'll dig into a bunch into. But everything that we're operating from a strategy side, we actually think has positive expected return and has a fundamental backdrop of why we design things that way. It wasn't a marketing exercise to see what we thought was really digestible by the public and easy to scale. And that's a little bit of early flavor, Jeff, just for some of your later thoughts of what other things are out there and what do you think about them. But I wanted to just let the table be set there and pass it back to Devin for a little bit more of an overview of the firm before we jump to the next steps.
What are the name Convexitas? Was it hedge fund name generator? Yeah. It would have had a river or a bay in it if that was.
Yeah, no, I think we actually were we were pretty orthogonal on that one. There were many ideas. We were actually both shocked that the Latin word for convexity was not in use. Like we went to the lawyers and said, do the work on this. And they went, no, you're clear. And we went, why don't you be
sure? Yeah.
But yeah, no, we came up with that one just, with the Google Translate.
And were the Romans even dealing with convexity? That's a whole nother concept for another podcast.
Yeah,
sure.
No, I think there's actually I don't remember well enough, but I'm pretty sure that there's records of futures transactions going all the way back to that period of time.
I love it.
And the fall of an empire is the ultimate convex moment. And
yeah, or Mount Etna. What was the volcano that buried all the people? Yeah, there's a couple tail events happen there. So dig into the firm a little more.
Yeah. So what we do, what we believe that we're different at is our whole viewpoint is that there's a couple things you have to swallow to really get the best implementation and the best benefit set and access to the best opportunity set in the derivatives management space. And it requires bringing a couple pieces together. So we set out to launch, as far as we're aware, the first true discretionary, all separate account implemented derivative manager in existence. And there's certainly people that kind of tick one box or maybe a little bit of both boxes, but we're really not aware of anybody that does it quite like us. And the reason that those things are important, Jeff, is that there's no funded solution that you don't end up making really big compromises on in the investment opportunity set. Okay, so you take your traditional tail fund, for example. If you're, first of all, there's all kinds of weird models of AUM and funding and so forth. But the bottom line is, if you have to put a lot of cash into it, right, and you have to take money away from an existing asset allocation portfolio, wherever you think your real alpha is coming from, to put on, for example, a risk mitigating strategy, then right off the bat we've got a big problem, right? There's a problem that you've now taken capital away from the primary assets. There's a problem that for the manager, and that it restricts their opportunity set, because now they've got to come up with things that are going to return 10,000%. So, the point is these things can't be funded, and that means that you got to run your mandate in a separate account, and that comes with a pretty big list of operational challenges that a lot of managers, particularly in the hedge fund world, just have decided that they're not interested in dealing with. I mean, and frankly, you go through some onboarding exercises with 4 or 5 custodians, like you don't understand why. But we've just chosen to bite off that apple and do it. We do run fully discretionary strategies. We do support, at this point, I think 6 custodians, 5 to 6 right now, with 3 more coming. So we're going to have support across all of the primary custodians here within a few months.
And the concept there is the mainly rebalancing of, okay, if I'm paying out on my hedge, and we might have buried the lead a little bit of, like, the main thing you're trying to do is protect downside, correct?
Well, I wouldn't say that. I mean, that on the risk mitigating strategy, that's it. But we also have other products that all operate off of the same principles. So we have beta replacement products. We run a product for one of the biggest RAs in the country that replaces semiconductor exposure in a very convex, nonlinear way, due to the particular options market microstructure that you can lean on in order to create that profile. Then, of course, our flagship product, Tail Liquidity, which is a risk mitigating strategy, we'll probably spend the most time on here.
Yeah.
And then we do some concentrated stock and single name large position risk mitigation and tax aware risk mitigation stuff as well. If there's a reasonable opportunity in that name, or in the name in question. But the point is, all of these things have a theme, and to get the benefits that you really want, kind of ranging from tax to liquidity to the correct investment opportunity set, it's really got to be unfunded. It's really got to be in separate accounts. So the manager's got to bite the bullet and then just do the work and put the pipes in place and write the code to be able to support it, which we have.
And talk to me a little bit of, you'd say unfunded, but there needs to be some funding in that account. You're just saying the money in the same account, but it needs to have some funding, correct?
Well, so it depends. It depends on the custodian and the product and the specific situation. But when I say unfunded, I mean we're not kind of creating. For example, if you wanted $100 million of tail risk of our risk mitigation strategy, Tail Liquidity, you're not writing us a $100 million check, right? Or even a $50 million check. We're collateralizing it with the assets that you already have in your account. So, depending on your specific situation and your custodian, we actually might be able to get the collateral requirements all the way down to 0 encumbered cash, or we might need some amount, low single digits of percentage of encumbered cash. But it's nothing like kind of the traditional world where you go out and you buy a pooled vehicle.
Right, where I'd have to sell 10% of my beta, fund it in this separate fund, and then deal with the rebalancing and the monetization.
Yeah, I mean, there's really 3 key things. It's, as Devin said, day one, we're not pulling capital from elsewhere in your portfolio. Your current portfolio is collateralizing all of our operations. There's no day one tax event. There's no lost opportunity benefit of not being fully invested. Step number 2 is, because it's your current portfolio collateral supporting our operations, it allows us to actually design we'll call it, more likely to produce value strategy rather than something that's fully funded. Because if it's fully funded, you have a very limited opportunity set. And if I have the ability to operate a strategy that's collateralized by your current portfolio, I have a vast opportunity set. So, step 1, we're not taking money away from anywhere else, allowing you to be fully invested, not creating tax events. Two, because of the structure, I have much better opportunities than other folks to try to deliver positive P&L. And then step three, which is the, we'll call it the most important piece, and is the piece that when we speak with folks, takes a little bit of hand-holding to get them to the finish line, is we are that liquidity provider during, market corrections, even too strong a word, even market sneezes, these little, 3, 4, 5% pullbacks, we're providing reasonably substantial capital considering the level of those moves for folks to take that cash and either service, lifestyle, i.e. they sell, 25 basis points of their portfolio every month to live, larger family offices, it's, service capital calls during drawdown events. You have to sell stuff. You have cash sitting there, or just plain vanilla redeployment of capital, which a bunch of our current investors do. Whenever we create 5% cash in their portfolio, they take that cash and they buy more S&P 500 like risk. And that's three kind of steps of, again, unfunded, meaning we're not taking money away from it's your current, assets supporting what we do, a better opportunity set, and cash to go ahead and be an opportunistic redeployer of capital during market drawdowns. That's why the operational structure is incredibly important for not only our delivery, our P&L in isolation, but more importantly, a client's holistic portfolio. Because once you hit those three steps right, we actually believe that we're ending up with a situation where your expected returns are going up, even though day one, this is a risk mitigating strategy. So, we don't know, like, over promise, but in theory, if everything works as it's intended, we think we have something that's going to increase the absolute returns of the portfolio while having a realized volatility of that portfolio of about half, or, reducing the mark-to-market risk of that portfolio in half. And if we're able to obviously achieve that with a mix of our discretionary management with the correct operational structure, then we really have something.
Then you've hit a home run. And what are the limits of that? Like, say I have the 500 founders or CEOs of the S&P 500, and they're heavily invested in the stocks of each of those companies. Are you customizing to each of those holdings, to each of those customers, or there's some limit of like the amount of customization that's possible?
So there's it's different. I think you're asking a slightly different question. I mean, if they have truly concentrated positions in single stocks, we have a different answer for that. And maybe depending on the single stock, we could add some value, and maybe we can't, depending on the vol surface of that particular name. But for the tail liquidity, for the primary product, it's all linked to S&P beta. So in order for us to really feel good about us providing a portfolio level impact that we can anticipate and control, we're really looking to operate it on the S&P equivalent beta of your portfolio.
Got it. Okay. So you're not messing around with Robinhood holdings or something?
Yeah, and Jeff, I'd go one step further, is to say, I think people kind of get this whole concept of bespoke hedging really wrong, because it's curious to me that no one would look at the alpha side of the house and not think that security selection and acting on the opportunity set that's available to you in the market is the most important thing, right? But then all of a sudden, when it comes to the risk mitigating side of the house, then it's, well, we're going to create this custom thing. Well, I mean, shouldn't the primary concern on the risk mitigating side of the house also be what opportunity the market is presenting to you? And that has absolutely nothing to do with the contents of your asset allocation portfolio. What the S&P surface is giving us, and the biases and dislocations on the S&P surface are that we can lean on in order to create the kind of convex and risk control delta exposure that Zed's talking about earlier. That has nothing to do with the contents of your portfolio. That has everything to do with the opportunity that's being provided to us. Now, that doesn't, we can do a lot with sizing, right? And we can say, how does your portfolio behave in S&P terms, and in what scenarios are those correlations going to be high, and in what other ones are they going to be low? But I think our business goes wrong when they start telling people that, well, you have this, so we're going to do something completely different. Like, it just doesn't make a lot of sense to us. And furthermore, most, having worked at an investment bank dealing desk, most of the quote custom things that someone's going to call the bank up for and ask for a price on end up reducing almost entirely to S&P anyway, right? Like, you're not hedging MSCI world puts with some complicated basket of, I mean, it's just not. It ends up, it's like 80 to 95% S&P anyway, right?
I'm thinking of the ARC, right? All these charts on Twitter now of like, here's all the holdings. A lot of them are down 80%. Like, for sure, there's tens of thousands of investors out there where each of those down 80, 70, 60% line items are their main holding, right? Their concentrated holding, which I think I hear you saying like, well, that was dumb. That shouldn't have been your concentrated holding.
Well, yeah. So, I mean, but that doesn't, so sure. Okay. But that doesn't mean that there's an opportunity for a derivative manager to come in and put something together that actually makes sense, right? Like if the prices of those single stocks and ETFs aren't tenable for a long-term risk mitigating strategy, it kind of doesn't matter, right? So like then the answer is
Tesla probably be a good example.
Yeah, you need to just reduce the risk of the cash holdings in the base allocation, right? So I guess what I'm saying is that the risk mitigating strategy doesn't work everywhere, right? It has to be treated with the same portfolio management and pursuit of alpha that the asset allocation side of the house gets, and that's not always possible depending on the underlying.
Yeah, I mean, they're as Devin saying, there's two different conversations. So say you're a $50 million family and 45 million of the net worths in Tesla. You came to us and said, I would like to reduce my Tesla exposure for obvious reasons, but my cost basis is $1, and that's a pretty hefty tax bill in California. What can we do? Well, we would look at Tesla vol service. We would say, you know what? I actually think there might be some edge here. If it was Microsoft, we'd be like, I got no edge. Like, go to some other provider that's just going to randomly buy puts, because that's probably going to be about as good as what I can do anyway, because I can't provide a lot of edge to Microsoft. But something like Tesla, maybe the outcome is we do think we can provide some edge. And what we're going to say to them is your experience is expected to be about a 2/3 mark-to-market risk reduction. Both ways, stock up, we're going to have a lot of losses. Stock down, we're hopefully doing our job and have a lot of gains. But the ultimate goal here is for you to tax efficiently sell that asset. And if folks aren't actually really interested in reducing that risk, then we're not the right folks either. Like we're taking 2/3 of the risk out day one without creating a day one tax event. And over the long haul, if the stock goes up a bunch, we have a lot of losses, tax loss harvest, use our losses to sell down stock. If it's an event where the stock goes down a lot, hey, we have a lot of gains, that's cash. You effectively just rebalanced your Tesla holding into cash and Tesla, again, reducing the amount of risk you have in single security. So certain names with certain, individuals where they have the right, I would say, attitude that they're truly trying to de-risk the security and they're trying to sell down, 25, 50, 75% over time in just a tax efficient manner, we're absolutely able to help those folks, but it's definitely a name by name basis rather than broad strokes. The other piece that Devin's talking about is our core offering and tail liquidity. And one we get like often, and he got a ton, in his previous life, is, my portfolio is in S&P 500, it's MSCI All Country World. And we would say, well, that's essentially the same risk. And would you really want to use MSCI All Country World, securities rather than S&P securities if we said that choice is reducing our expected return by over 150 basis points per annum, and you're giving up a ton of liquidity? And if you hopefully go back through that exercise and say, now the point of having this here is liquidity during drawdown event, and you're saying there's edge in S&P 500, I'm willing to accept a little tiny bit of correlation risk between MSCI All Country World and S&P 500. So, those are kind of like two completely different categories, but how we think about, our strategies interacting with those portfolios.
So let's build on the tail risk mitigation strategy. That's the official name. What's the flagship's official name?
Tail liquidity.
Tail liquidity. So let's build on tail liquidity. I think of it as a gamma delta hedge play. We'll let you expand on that, but It's kind of like everyone's talking about, right? The market makers these days, and they're getting all this option flow and they have to delta hedge it. And that's driving flows, that's driving market prices. I somewhat see you guys in that same spot from seeing some of your trades. But you're choosing to be long vol and short the delta. So talk to me a little bit about the different dynamics there of kind of hedgers reacting to where the market goes, and you're kind of doing what you do and reacting as well to where the market goes, but on purpose, so to speak.
Well, I think what I first say is that the very significant difference between us and the more traditional tail risk approaches is that we are relying on a delta position that's there all the time, right? So there's a reliable, let's call it base beta to tail liquidity that's always present, and then we're managing the amount of convexity of that delta and the amount of convexity that we carry all the time. So that's a lot different than most of our competitors that are relying on changes in vol or vol convexity in order to generate returns in really significant events. And it's just basically our point of view that the correlation between spot and vol, first of all, is in a completely different regime. That's not even debatable. Just look at the last decade of data. So the idea that you could design a strategy and then pretend like you know what's going to happen if we have a 2008 like event, we just don't buy it, given almost a decade now of very different spot vol dynamics. So this idea that you can rely on vol expansion to provide these tail outcomes, we just think is very, very challenged, right? But not just because of the market microstructure dynamics, but because really what you want in a program like this as an asset owner or a professional portfolio manager that has allocated to it is some predictable behavior so that you know how it's going to interact with the rest of your portfolio. So we set very clear guideposts about what you should expect in terms of returns from us, given a move in the market. And the expectation is that clients can then take that, and because it's in a separate account, it throws off cash and assets that are immediately fungible and usable. You can go out and rebalance immediately, right? So instead of having an event on the 10th of a month, on the 10th day of a month, and then you get a statement at the end of the month saying, well, this is how much you're up, right? On the 11th of the month with us, you can take cash is in your account. Take it and go buy some more assets, right? Well, rebalance your portfolio or do what you need to do. And that long-term compounding time and market that viewpoint is a significant departure from the allocate, wait for it to expand, and then maybe redeem it style of thinking and model. And that's only possible if we started this whole question around delta and kind of managing a convex delta position. That's only possible inside of that framework. So we're kind of coming at the risk mitigating question in a completely different way than most of our peers, and it's really intended to be a tax aware portfolio level tool. Right. So our goal is if the market's down 10%, you should expect the overlay to give you 5% of returns back. But also you should be ready to deploy that into the asset mix that you've identified at that time. So it's a whole different way of thinking. So yes, right, it is very delta or in option speak, convexity, gamma focused. That doesn't really have much to do with kind of the flow and facilitation world where dealers are facilitating options trades for clients and then instantly hedging their risks. That's those flows are byproducts of that facilitation flow. And generally speaking, Jeff, I'd say that people make way too much of it. Having been on a flow dealing desk for a decade, and and facilitating some of the largest trades that were out there in the S&P and the VIX on our desk, I'm here to tell you that those types of flows may generate, let's call it 4 to 8 handle impacts on the S&P futures in pretty extreme situations. No one who's listening to this podcast, unless you happen to run a high frequency trading shop, really stands to benefit from those types of very short-term dislocations, particularly when you're focused at the portfolio level, right? Like, if you're a high frequency trader, and you can lean your deltas, and you can provide liquidity into that, what might be 30-second to 15-minute event, maybe, that's the opportunity. But kind of otherwise, people make just far too much of the dealer flow impacts. Not to say that they are never important. They can be important in single stocks. They can be important in really extreme situations. But for the most part, it's a magician's cant of distraction.
Yeah, but I think my question is more of it seems to me you're the same as a market maker who's constantly buying puts from the public, right? Who's facilitating selling of puts, and you have that same profile, and and kind of the mechanisms are the same of how you handle that exposure, but you have the exposure on purpose.
In a way, we're reacting to the dislocations presented to us from different players. There's a big community of people selling options on the short ends, which does depress the price of options, right? And that's a big part of our strategy. There's a big community of insurance that's buying the middle parts of the curve. That's an important part of our strategy. So, there are persistent dislocations that matter, but, these kind of very short-term flows resulting from delta impacts, like I said, it's just way too much gets made of it.
Yeah, I think, the quick summary is, the option flows, especially systematized option flows, have almost no impact on market direction, but they do have significant impact on option pricing. And those are two very, very, different things. I think a lot of people extrapolate that and say like, oh, the reason why, S&P was up, down, whatever today was because of these, predominant option holdings. And that, I would say is a bored sales guy needing to print a note rather than something that's factual. But they do obscure pricing of specific options. And that's the piece that we pay attention to, because, Delta's kind of whatever you want it to be. We can add futures, subtract futures. We can make it a long leaning product, a short leaning product. We're harvesting what we think is relative value within the volatility surface, with the main components, as Devin said. We think shorter dated stuff's too cheap from all these systematized, option sellers, and we think mid curve stuff is too expensive from a known quantity of insurance players that are, systematized buyers, and we're extracting a little bit of what we see as relative value in that surface, but we could, package that expression into any product we want. The point of designing tail liquidity as we did is we think we have a relative value expression that has a positive expected return. What the marketplace is probably in need for is a means of risk mitigation rather than the traditional format of just diversified portfolio bonds, whatever the heck you want to throw in there. Probably not going to work really great. So we need to come up with a new way to diversify portfolio. And we think having a negatively correlated, asymmetric, unfunded overlay is the best way to go ahead and achieve what the market needs. And then the final step is, we don't want our product to be the driver of the excess returns in your portfolio. Sure, we want to have a positive P&L over time. That'd be great. But what we want is the reinvestment of our capital that we deliver during drawdown events to be the excess return driver, the buying the dip and holding onto those assets for the long haul, i.e., they're unrealized long-term gains. Because if all the excess returns were in options in a taxable environment, that's not very attractive. Half of that's going to the tax man. So we designed this, again, foundation. We think we actually have some edge from a relative value standpoint. we believe the marketplace is looking for a new means of diversification with yields, well, almost a 2% in tens, but where they are. And we think we're providing that as a new fulcrum within their portfolio to achieve better outcomes for diversification. And then finally, how we design, we'll call it the core delta lean within the portfolio, which is totally fungible. We can make whatever we want. But the point of it is we want most of the returns to be from reinvestment of capital because that's tax efficient versus if all the P&L is coming from options, that's problematic for a taxable investor. So that's the waterfall of kind of how we ended up to where we are with tail liquidity.
Right, but it's mostly always, or you tell me, always short deltas and long gamma,
Always.
and long vega. Yeah.
No, not always. Not always long vega.
Got it. Okay.
It's normally short vega.
Okay. So that short vega is paying for the other two in essence.
The short vega is definitely in there because we think most folks are overpaying for, we'll call it meaty options, vega driven options. A shorter dated option, the implied volatility or quote unquote vega is almost meaningless to factoring into the price of that option. When you start adding a significant amount of time, maturity to options, then the weight of vega to the pricing of that option increases. And we believe that generally people are overpaying for that vega component in the longer mid-tiered, even longer dated options, driven by a lot of systematized flows that again are economical for that end user. But ultimately, that's why we're leaning on that, what we see as a mispricing within the portfolio.
And that systematized, you're saying basically people don't want to buy 5-year leaps, too expensive, too much data. They've come into this middle zone where they think they're getting value for that downside protection.
Yeah,
it's mostly a regulatory issue for the insurance folks. Those are the options they have to buy because those are the options that give them the regulatory relief that they need.
Okay.
And very simplistically, most of it's driven by annuity product, which annuity product is incredibly high fee. So if they're overpaying for their regulatory hedge of 25 basis points, who really cares? go sell some more 6-point front load product, and we're okay with giving up a little bit of edge on the regulatory hedge.
But you're basically saying, all right, I'm a bank. I sold some index linked annuities, and I'm covering if the market goes down more than X, is how the annuity is set up. So I have to buy those puts in order to protect myself.
It's more unlike, well, they want true vega rather than necessarily anything directional, right? Because if you have a 30-year annuity, the biggest risk for the annuity provider is mark to market. It's path. Path is the problem. So they're trying to hedge path, and the easiest way to hedge path is to own vega. And historically, they own vega via variance swaps, longer dated variance swaps, but that market has dissipated to almost nothing outside of kind of 2-year maturities. So they've shifted that vega exposure that they need within that product, both from a risk management, but also regulatory side of the house, into listed options. And so they're just trying to replicate, the vega component of the variance swaps that they utilized previously, just now using S&P 500 options.
Why did variance swaps go away? Alberta?
Well, because banks, the amount of capital they have to carry against the other side increased astronomically post the financial crisis.
Okay. And speaking of the options volume, wanted to touch on, well, 2 things. One, the delta hedging. It's always seemed to me, how do you get that timing right? If you did it every second, every tick the market moved, you'd get eaten up in costs and whipsawed. If you do it monthly, there's going to be moves you can't monetize and can't take advantage of. So how do you thread that needle and get the delta hedging exactly right, or mostly right?
Well, mostly right, even strong. I mean, long gamma scalping, everybody will have a completely different answer of the right way to do it, because there really isn't any right answer. And the truth is, we have 2 components to indicating for us to go ahead and gamma scalp. We do that rebalancing. We have we'll call it the scientific side of it, which is our guardrails, which is a forced rebalance. And that's if the portfolio is going from short to long. That's not why we're here. We're supposed to be negatively correlated. That's a forced rebalance. And if the portfolio is getting too short, and what we mean by that is if somebody's allocating $10 million to tail liquidity, and all of a sudden the portfolio is short $10 million and $1. That's oversized. That's not why we're here for. That's a forced rebalance. So those are our set in stone. We'll call it scientifically driven rebalances driven by those guardrails. Inside of that, it's we'll call it the art bit. And the art bit, the main driver is what we see happening to fixed strike vol on any given day. So when we see fixed strike vol absolutely collapse, that might afford us a little bit more, we'll say, time before rebalance. We'll let things drift more towards those guardrails rather than trying to chop things up pretty aggressively intraday. When you have a significant move and fixed strike vol higher, that's probably a moment to go ahead and additionally capture inside of those guardrails, so the art side of things. So, everybody loves things that are formulaic. But if it was formulaic, then it probably wouldn't have much true edge to it. So we have the dual component of product-driven rebalancing that is hard-coded, that is a guardrail, along with allowing us the discretion to utilize a little bit of art from what we see intraday to hopefully add some value.
And just talk through how that works for a second. So I'm day one, I buy puts, I sell futures, I'm delta neutral, or I buy less futures and I'm short some deltas. Just talk through how that works of when the market moves down towards your strikes, you become more short and vice versa.
Yeah, so we have three set in stone drivers of our guardrails. One is delta, again, can't be long and can't be shorter than 100 deltas. Two is long gamma. All long gamma really means is as the market falls, we get shorter and shorter and shorter. As the market rallies, we get less short, less short, less short. And then we're always net long put contracts. So there's no hidden jump risk in there. October 87 happens and you're like, ooh, oops, like it went down too fast. That's not a thing. We're always net long puts. And so we're always in that situation, even in a jump risk scenario, that we're always going to have improving P&L as the market goes down. So those are set in stone guardrails. How we are delivering our expression is we're basically buying shorter dated, closer to the money puts. We're selling, mid dated, we call it 6 to 12 month zone out of the money puts. So buying close to the money, short dated, selling mid dated out of the money. And again, always net long puts. So always own a little bit more than we're shorting. So what this means is when the market rallies, that initial trade most likely is collecting premium, which means at some point in time during a rally, we actually flip to long because we net collected cash. If the market went to infinity, we just get that cash essentially. Yeah. We collected from day one. So as the market rallies, because of that expression, we will potentially hit a moment where we're actually long leaning, forced rebalance. The side that you care more about is when the market goes down. And so we're long again, shorter dated, closer to the money puts, which means as the market falls, the delta of those shorter dated puts is accelerating much, much faster than the puts that were short, i.e. it's long gamma. And as the market falls 1, 2, 3%, when we're in a relatively low implied vol environment, that creates a pretty significant shift in delta. I mean, we can go from short 20 to 100 deltas on a 3% move with these low implieds and how we're expressing our portfolio, which would incur a guardrail-induced rebalance if we make it to 100. So
by buying the beta, buying stocks or buying futures. Yeah.
Right. And so, the way, we can rebalance is in our core offering of tail liquidity, we're just going to roll down the puts. The puts that we originally bought, we're calling it 30 delta puts, and now there's 60 delta puts. Sell the 60 delta puts, buy new 30 delta puts. Like that's going to be the normal rebalancing is just, hey, the fulcrum that drove the long convexity within this portfolio and drove a majority of the positive returns as the market fall, just rebalance it. And that's going to be just moving the strikes lower of those puts in 9 out of 10 cases.
And so I was confused. So at trade inception, you're not long futures delta or SPY delta or whatever. It's just an options position.
Yeah, no, we're in tail liquidity. We're only holding SPX options.
Why is it so hard? What do people get wrong about that dynamic?
So I think there's two main categories, and we'll call it, there's the tail risk hedge fund folks. And those folks are only going to get a 1, 2, 3% allocation of your total portfolio. And that means that they have to have, 1,000% returns during the event, or else it's just not material. You allocate 2% to somebody, March 2020 happens, they're up 100%. Like, oh, that's great. And then you look at a portfolio level, you're like, that's up 2%. Why the heck have I been carrying this thing all these years? It didn't actually provide me any benefit.
So they can't afford to roll it down. They got to hold it.
Right. And so those folks, we're not saying that they're, not brilliant vol guys and are looking for the best expression of what they need to provide in that fully funded format. That's not what we're saying at all. But they can't participate in long gamma because long gamma just does not have that convexity in that portfolio for those types of events. They need anything that is a half delta option, which basically the only pricing of that option is the vega component, and it goes to a 3 delta option and a 10% draw, 20% draw, 30% draw, and they have 10x returns. They have to participate in a different environment than what we are, simply because it's fully funded.
And you're not saying a 50 delta, you're saying a 0.5 delta.
0.5.
Half of one.
Half of one delta. Yeah.
So like a 2,500 strike
as we
right
come
now. Right.
Yeah.
Exactly. The other side of the house, there's players out there that have, done the legwork on the operational side to be able to provide derivative overlays and separately managed accounts, even in the, we'll call it traditionally retail setting. There are a handful of folks that have gone through that operational exercise. The issue is long gamma requires a decent amount of attention. And I think, Jeff, you've seen it from our interactions. If the market starts moving, there's going to be 1 to 5 transactions possibly in a single day. And these other folks may have built a great operational framework to be able to do execution focused mandates across all these custodians in retail environments, but they're not very well set up for something that is actively managed. And so most of the products that they create are things that actually net sell optionality, not buy optionality, because when you sell optionality, usually just freezing is an okay seat to be in. And so that's why, what you would probably think of a traditional derivative overlay manager, especially down the wealth channel, are people doing collars or put spread collars because they're quasi set it and forget it, 6, 12, 18-month type transactions. And again, these folks have did a great job from an operational standpoint to be able to implement these execution-based mandates, but they're definitely not set up to be able to handle something that has a pretty high level of attention and activity down those pipes. And so, we again think we're threading that needle of we're providing the asymmetry at a portfolio level that in theory a fully funded tail hedge provider is trying to do. We think we're obviously better at it because we're participating in a totally different environment. But then we're also did the legwork from an operational side to be able to do separately managed accounts like some of the handful of other folks out there.
And what's that look like? What's the worst case scenario if you like down 3%, up 3%, down 3%, some sort of whipsaw thing?
That would be excellent.
Best case scenario. Give me more of that. That's what happened in the first 2.5 weeks of this year is exactly what we love. Where, as you say, we're moving.
Then you get to monetize, then it bounces back.
Right. We're monetizing something every single day. So, that's the fantastic situation where your underlying asset portfolio, we'll just call it S&P or S&P-like securities, is flat to up. But we've been able to monetize positions through time just from market movements. And you end up with the, stocks up, tail hedge up, and maybe even redeployed some capital somewhere in the middle. You get all three as a win. So anything with the market moving is great, which obviously means the bad environment is when the market does not move. And, I'd say like the worst case scenario from recent memory of something along those lines is 2017. So, 2017 had fantastic returns for risk assets. And we tell folks that our expected delivery is a 50% capture of the downside and 20% drag on the upside. And in a 2017, with the market up mid 20%, you'd be like, okay, I'm expecting you to be down 5. And yeah, we're probably down more like 7 or 8 because it was a incredibly low realized year. Now, you as an end user still have a mid-teens, equity return. So that's nothing to scoff at, but yeah, you're not going to be happy about our performance during that environment, without a doubt.
Wasn't that the record number of days without a 1% move? Like 70. I can't remember what it was, 60, 70.
It was a very quiet year.
Yeah. And I've also, you mentioned the 20 and 50. I view you as, which is a different bespoke product, but, losing 50% of the upside, capturing 100% of the downside, which I guess is same thing, right? Capturing 50% of the downside, giving up 25%, what's called. I actually ran this when we started talking last year, just on S&P returns, and looked at it as, right, if you just flip the return, multiply it by 100%, multiply it by negative 50%, that was a positive return, which seems a little bit counterintuitive, especially in these years where you've had kind of seemed like a runaway train up. That was a positive return. I think it was over the last 5 years, which speaks to this isn't just capturing that, it's an absolute return strategy.
As long as there's market movement, our goal is to, we'll say, be able to fight our way to a neutral seat, even when the market's appreciating. But again, the ultimate win for everybody involved is when we have these little bouts of, obviously 2020 is the perfect, right? A really positive year with a lot of volatility. But, other years where we've had, 5 and a couple 10% corrections in there, we're hopefully doing our job, delivering, 2.5 to 5% cash in those 5 to down 10 market environments. And you're taking that cash and buying stuff. And that stuff over the rest of the year has hopefully appreciated with the rest of the market. So, that dollar we gave you is now worth $1.20. And that's ultimately what's going to drive the accelerated returns over the long haul, is that reinvestment of capital.
And what about the flip scenario of like a 17 in reverse, right? If we just crawl lower over 12 months, that would make a lot of people unhappy on a lot of fronts. But what does that look like?
Yeah, we would do okay in the environment. And the reason for that is where I think, again, a big differentiator between ourselves and our peers is our peers are really set up to only make money in super violent scenarios or market down, 10, 15, 20% plus scenarios. How our strategy is designed, because we'll call it day one short 20 deltas and it's long gamma, as soon as the market starts falling, we should start creating positive P&L. Now, without a doubt, a low realized vol environment is worse than a high realized vol environment, but we're still going to be achieving positive returns simply because our day one delta is negative and we're long gamma. So it should be accelerating even if we're just going down, 50 basis points every single day. Right? We're still performing our job. Our job is just a lot harder than if we were moving 2% every day.
And then let's talk for a minute. You mentioned retail somewhere back there. Like, what are you guys seeing from your seats on this huge explosion in retail option volume? How do you think that movie ends? Is it a good thing overall for the space? Is it a bad thing? Is it a bad thing for those retail investors? What are your thoughts?
Yeah, well, so first of all, most of that activity is concentrated in a handful of single names. And it's very, very short dated, as in, 2 weeks or less. So the actual surface impact at the S&P level doesn't exist really. So, in terms of impact on our strategy, the answer is almost none. Now,
there's literally only a 2-week period, which was at the end of August, beginning of September 2020, where a lot of that retail activity, which, as Devin said, is buying 1, 3, 5-day call options. That was during that period. There was a lot of doing that in things like Amazon and Apple and Google, which did for a very, very short period affect implied volatilities and things like the S&P 500 or the NASDAQ. But outside of that little window, what we've seen from the, we'll call it new retail activity, has had no effect on the index level.
Right. Now, is it a good thing for the investing public to be, to be trafficking in options in this way? I mean, that's a bigger philosophy question. It's funny. Just today, I got a OCC disclosure booklet, this year's OCC disclosure booklet, from one of the custodians in the mail. And it's now, I don't, it used to be like a notebook calculator sized book. It is now a full 8.5 by 11 approaching binder of disclosures, which I don't believe is a mistake. So, you know, I don't believe in not letting, you know, in stopping people from investing in they want to invest in, so long as they have, you know, some reasonable understanding of the modicum of risk that they're taking. And you know, as a former, you know, registered options principal at a broker dealer, I hope that the person signing the registered option principal signing the account opening forms is, you know, is doing enough due diligence that says that the person on that form knows the risk that they're taking. And I'm just going to kind of leave it at that.
Yeah, but surely that's robo stamped at Robinhood or something, right? No way they can sign 60 million.
Yeah, it would seem unlikely that that at that volume you can perform thoughtful due diligence, but no, that's for the regulators to decide.
Right, but to me, the actual end investor is going to quickly figure out of like, oh, hold on, this doesn't make sense. They said if I buy calls and it goes up, I make money, and they're going to just keep experiencing these things of like, I bought calls, the stock went up, I didn't make money. What the heck's going on? Right. And then they start getting into like, well, okay, there's more pieces to this than stock goes up, calls make money. So to me, it's going to like self-correct a little bit of, you know, that the vols got so high because they're buying. I mean, it worked for a period, but it seems like it's just going to self-correct.
Somebody I work with at Legal in General said one of the simplest and favorite phrases that I've ever heard in my career. And the problem with options is they expire. And I think something as simple as that is what these folks, as you say, might be learning along the way of, yes, you know, XYZ company went up 30% over a year, but you kept buying 5-day options and you might have not participated in that move because the problem is they expire.
Yeah. Or the problem is it's already priced in. It's like a game of probabilities. You guys know better than anyone, right? Like the option's telling you the probability of this event happening. So it has to go greater than that event happening. Anyway, I think we're all preaching to the choir there. We talked a bit about it of dealing just in the S&P. It's kind of the de facto world risk on hedge. But I've heard you, Zed, talk about the move by hedge funds away from CDS swaps and whatnot. So just dig into that a little bit more if you could, of like why S&P, why people may be moving away from other risk choices.
Yeah, so we'll say this is, we'll throw it in the theoretical camp rather than hard proven.
Zed said,
yeah. But I you know, a vast majority of large hedge funds, even non-macro ones, fundamental hedge funds, tend to have some sort of, we'll call it teeny put embedded within their consistent exposures. And oftentimes that teeny put was, you know, credit of some variety, whether it was just linear, you know, CDX, you know, buying, you know, IG CDX at whatever, 28 basis points. That's not a lot of negative carry. And when things get hairy, it goes to 400 over, and there's a lot of convexity in that. Whether it's buying, you know, puts on high yield indices, whether it's, you know, HYG and or high yield CDX, things along those lines, they utilize credit as their main fulcrum within their portfolio to have that deep out of the money protection. And again, the two reasons for that are optically it's cheap from a carry perspective, and two, it doesn't require much maintenance at all. You know, you do CDX, the new contract comes out every 6 months, and you just go ahead and roll it to the new one. You know, it's 5 minutes of work every 6 months, so it's pretty easy to go ahead and implement, you know, as part of your overall portfolio. You know, what finally changed in March 2020 is, you know, the Fed, rather than just buying MBS, ABS, treasuries, bills, so on and so forth, we'll call it government plus securities. They bought, you know, IG and even high yield ETFs. And I think folks' conviction that those teeny puts, if you will, in credit are going to work in the next crisis is at least lessened, simply because the Fed has already opened the kimono that they can just buy stuff and stop it from widening.
Right.
And you need this stuff to work. Like your good old Ackman Pershing, why they had that Gallivant 2020 year is they produced 20, 30, 40% portfolio level returns on the CDS, and they monetized it, and then they bought a bunch of stuff, right? It's like they have the perfect flip because it actually like does work. And that's what, these hedge funds are hoping to have in there. And if you don't think that the Fed is potentially going to allow credit to widen, but you still want that exposure within your book, you got to go down the risk ladder. That's what the Fed's very good at doing. It's forcing people people up their risk ladder. It's even working on the hedges. So rather than utilizing, credit, they're buying teenies and the S&P 500. And, we would argue that the last, especially like call it 9 months, your longer dated deep out of the money puts are astronomically expensive considering the realized volatility of what's taken place in the S&P 500. The last 6-9 months realized volatility is like a 12.5. The average is 16, so it's been very quiet. Along with we've had little sneezes here or there, but generally an uptrend market, and yet these deep out of the money puts continue to get more and more expensive from an implied volatility standpoint. So my we'll call it thesis here is if I was running a $10 billion macro driven hedge fund and I need some teenies in my book and I used to implement it via credit, I'm scared that that's not going to work next round. So I got to go up the risk curve to equities. And that's going to be teeny puts in the S&P 500.
And then couldn't I argue the Fed next time maybe just steps in and buys S&P 500? And then then the whole cycle starts over. Like now where do I go?
You got to buy puts and lever private equity. Just keep going up that risk curve.
And to that point, like, so if all this hedge funds, if everyone owns these puts, there's 10 years ago, 20 years ago, we wouldn't be having this conversation. There was just a few groups focused on kind of tail hedging. Is it going to feed on itself? Like, can we not get the cascade down and the big jump down because there's so much protection?
So again, our pretty confident view is flows and or holdings in options market is not going to drive delta in any significant way. So if everybody's protected, so that stops the market from falling further, not really. Like that's just a storyline in our view. It's not really driving changes in market.
Well, imagine if you were a $80 billion fund, right, and even larger, $800 billion fund, and you're remonetizing and going back in and buying, right, it would have an effect. It would be putting a floor under there. So
forced liquidations is a different construct. I would agree. The forced liquidations can trigger different unwind events for sure.
Yeah.
But the more important piece again is rather than we'll say folks overpaying for this deep out of the money, catastrophe insurance in the S&P 500 creating an effect on where the S&P 500 is going, it does, in our view, have a significant effect on option pricing and the option pricing during that said event. And what we mean by that is we actually think that the implied volatility on those options falls when the market falls. And folks, again, if you're buying a deep out of the money put, 12-month 5 delta put, the driver of the pricing of that option is not the move in the delta. It's not the move in the stock market. It's vol expansion. And what we actually think is going to happen is because you're quote unquote overpaying for it today, market goes down 5, 6, 7%. The vol on those options is actually going to contract, not expand. And the entire point of owning those is expansion of vol. And so you're going to have a move in the market. We'll call it, a moderate drawdown. I'm sure if the market goes 50%, it's a totally different story. But, market down 5, 7, maybe even 10%. We actually think those options just don't make any money. And that's ultimately, the problem when too many folks are utilizing the same instrument.
And I think we saw that in October of 20, right? With all the election vol bid up and everything. And then the market did go down, but it was a nothing burger in terms of vol.
Yeah, you saw December 2018, fixed reg vol came in during, a reasonably choppy and downward month. You saw it as you said, around the election. That was an event that rolled off, so a little bit different than just natural drawdown. But even saw it, September of this year. It was only a less than 5% move in the S&P 500, but vol came in hard during the 5% down move in markets. So we obviously, this is embedded within our strategy. This is why we're saying we're short Vega 9 out of 10 times. Is we do think this is mispriced, and we think we know why, and we actually think that it does contract during the down movement. But as always, when there's too many folks doing the same thing, and the event that they're all supposed to unwind it happens at this, and they all go to unwind it at the same time, might affect the pricing of that security.
Just a bit. And let's talk about the flip side of that. Right, people say, oh, there's not enough institutional vol selling right now for there to be a big crash. Right, there's not enough people who will puke and start buying their way out of those short options. Where do you guys see us on the short institutional vol selling curve? If we say like early 18 was the top, perhaps, or tell me the history of it if you know.
You want to go, Devin, or me?
Yeah, I mean, it's not. I'll let Zed do most of the talking here, but the answer is the biggest players in this space come from retail and private banks, and they are undeterred. So for the most part, this exposure is still out there, kind of very close to maximum levels. And if you think about how a private bank works, they go out and they go out and sign up hundreds of clients or thousands of clients for these strategies individually, right? That's a completely different dynamic than if you are managing a short vol allocation at a pension fund or any type of commingled vehicle where there's a portfolio manager and a much more prescient agency problem associated with that manager, right? So they might get some redemptions, but each account has signed up to the risks individually. That's the short vol trade is very, very, very durable at this point. And we believe continues to create this this pressure on the front end, to the point that we can use it and monetize it, and it would take a really, really significant move to shake people out of that, in our view.
Yeah, and I think it's actually different rather than just getting having losses on a large drawdown. I actually don't think is the function that causes folks to not jump back into the short vol trade afterwards. It's as simple as yields going up, right?
Mm-hmm.
It's the main driver of a lot of this is just, we'll call it quote unquote yield replacement type strategies. Right. And so if credit is only IG credit's only paying 2.5% and high yield sub 5 and real returns negative, everybody's hunting for yield, which means everybody's going to sell options, and they're just going to embed them in a bunch of different products that don't say options, but they're selling options. Now, we get 10s to 6%. Maybe they slow that down. They have other choices to go ahead and find yield. But in this low yielding environment, it's fully there and probably accelerating beyond where it's been. And we just need to look to the folks in Asia for an example. Like, it's a persistent option selling world for 20 years, and it doesn't matter what the market does. They're always there because they have to find distributable returns of mid-single digits, and there's no other choice.
I want to get your thoughts on some different vol strategies. We've had some fun in some of Chicago's finer establishments talking through these. Let's start with what we've already covered, and you can just do a line on it. So the Taleb style deep out of the money option put buying, I think you've covered it. Give us just a last one liner on it.
Yeah, going to be tough for that to work in this vol regime. I mean, as we just talked about, vol doesn't necessarily go up when the market goes down 10% anymore, right? It was certainly not for the first 10%.
I mean, way more simple. Huge monetization problem.
Huge love it. The sombrero trade, as Jason Buck and I like to call it, which kind of short the belly, long the wings. What are your thoughts on that trade? You guys have a little bit of that concept in your stuff, right?
Well, that version of how you describe it is the ultimate marketer's dream, which means it could never make money, right? It's the old, hey, it
Yeah.
produces 2% a month and limited risk of, I don't know, just pick 2%. And people in their brains instantly go, 2 times 12, 24 with a max risk of 2. This sounds amazing, except for, market slowly moves down a significant amount in December 2018, and those strategies lose 16%. Your risk wasn't 2. So, anything that's really, really easy to sell probably has some issues.
Right. But that's been working for most of the last few years, right? Because if you have the sharp kickbacks, it works. If not, right, or if vol goes, it has to really go, which is what we've seen. Touched on this a little bit, but the JP Morgan hedged equity, buffered notes, all the collar stuff, just your overall thoughts on how those are all structured.
If you want 0.7 beta for 20x fees, go for it.
Right.
Yeah, I mean, and a lot of taxes, right? I mean, just the problem with this whole, there's 2 big problems with this entire camp of products, which is first, getting in and out of them is a tax event, right? And it seems like, I mean, it's unsurprising. A lot of the folks in the product management world here came from institutional thinking, and so this just doesn't get on the radar. But the answer, the second problem is that the risks are very dynamic depending on spot, right? So to the average advisor buying one of these buffered products, I just refuse to believe that they actually understand the risk that they're taking. I believe that they understand that there's a collar in there, and that 3 days before those options expire, they know what the profile is, but they don't know what the risk is on any other day. And so the people who make these products respond by creating more series of them, which only makes the tax problem worse.
Yeah.
Right. So there's no squaring the circle of path dependent risk and really bad tax profile in the buffered product space, no matter the wrapper, right? Whether it's a structured note you buy from a bank or an ETF or ETN, whatever it is, right? There's no squaring that circle of difficult to no risk if you're not a professional, and in very difficult tax situation to enter and exit. What you prefer, this is why we exist, right? What you prefer is to actually put the options that make sense directly in your account and not disturb your asset allocation.
Right. And what was I reading? The hedged equity program, the calls are almost right. They're almost at the money now, right? So they buy all the puts, then they had to sell the calls to fund the puts. And it was 10% out of the money, now 8%, now 5%, and it just keeps coming down. It's there's no upside, and you're collaring, you're taking the first 10% of loss. Doesn't make a lot of sense. Implied versus realized vol arb type strategies.
Yeah, I mean, okay, so here it's difficult to paint with a hugely broad brush. I mean, there are professionals that really know what they're doing, okay, and there are good products out there. If you can go and invest in what I would call the top tier of hedge funds in the space, with people that have real pedigrees and really know what they're doing, okay, but there's not many of them. And we are talking about writing real hedge fund allocation checks. I think that what disturbs me a little bit is that there's a tier right below that where there's a lot of magician can't hand waving going on about relative value and options world in the VIX. And for the most part, outside of a handful of the people that I think really know how to run a hedge fund in a relative value vol strategy, it's kind of scary. I mean, really, right? So there's a big dispersion of quality here, and I do think that there is good stuff, and I think that they're mostly absolute return strategies that that belong on the alpha side of your portfolio, not the risk mitigating side of the portfolio. And I do think that there's a lot of landmines you can step on depending on the manager that we're talking about.
Which is because per your view, there's no signal there in realized versus implied. It just is what it is for whatever period long.
I think that I think that the sophistication required to really understand the flows of where those dislocations come from. I mean, like there's a bit of this in what we do in the specific security selection and understanding how much edge we actually have to work with when we select the options that we do for the risk mitigating strategy. But there's a relatively high level of sophistication that you have to have in order to assess these things, to size them correctly, and then to do the risk management. And based on almost all of the commentary I hear, I don't believe there's a ton of people with those skills. So there's good stuff here, but you got to be careful.
Yeah.
So the key word to be careful is anybody that's pitching something in this category that focuses on the word yield. If you hear the word yield, run.
Right. If we're generating a yield by selling high implied versus realized.
As Devin said, it's an absolute return type of allocation. Yield is the easiest means to sell, just selling the concept of selling options.
And we touched on it earlier, and you just touch on it now, but pure flow traders, all that matters is gamma and delta hedging and where the market makers are at. Thoughts on that type of strategy?
Yeah, I mean, at any reasonable size, I don't even think that's a thing, right?
I think Chicago prop discs, yes. Outside of that, no.
I don't think there's people out there divining the net positioning. I mean, just give me a break, right? Like, I think that if you're close enough to the flow, if you are a large automated market maker, you do have some information. You do have, they're the only real people in the market able to take advantage of, let's call it extremely temporal, sub-minute to small number of minute type dislocations. I do think that's a thing. But I should also say, I think that there are talented prop traders that have strategies that they can't make bigger than $10 to $40 million, right? Like,
yeah.
I think there's that too, and that's successful because it's small. But if we're talking about product that you're going to go out and buy, I'm highly skeptical that there are independent folks that can divine the net positioning of dealers and somehow profit from that.
Well, but that is a little counter to like JP Morgan hedged equity and their size, and their strikes, and in theory where the hedging needs to be.
Yeah. Okay. But great. Like, so like you identified a 1/2 to 6 handle dislocation in the S&P.
That's a
what are you
great one.
Do with that? I mean,
great one to bring up, Jeff. Like this December 31st.
Yes. Thank you, Zed.
JP Morgan waited literally until the 31st to roll the entire hedge equity product. And obviously those are all deep in the money calls, right? And so essentially on that roll, they're buying, 10 plus billion deltas. And they're all going to do it in one print. And everybody in the world knew it was coming. And we're going to be able to take advantage of it. And it moved the market zero. So you're like, everyone on vacation, all this. It should be the perfect setup. Nothing. So it's a fun story.
Why is that? Are they crossing it with someone who has 10 billion to sell, or is it just the market's that deep and liquid? It just ate it up. Why is that?
It's a mix of the desk that they're working with has the appropriate time to prepare to some extent, along with just it's not a big enough dollar amount to move things. And if JP Morgan hedged equity product isn't moving, S&P 500 futures, there's not much else out there that can.
Right.
So it's fun. It's fun for people that use Twitter, but it's not an actual event for making money.
Right. Because what is it? 18 billion or something into what's the total market cap? 5 trillion or something. We'll finish up. Want your hottest take? We're talking Chamath style, foot in your mouth sound bites. If you have any refugees to insult or anything, but no, something market related, your niche related, nobody else is talking about, something everyone is talking about but wrong, or as I told you guys in the email something like Tom Brady sucks or the Beatles are overrated, which is very.
I'll kick it off.
The Beatles are overrated.
Yes, nice.
This isn't going to be as hot as no leg day, Chamath, but I think my hot take is that Congress is going to greatly reduce the Fed's tools over the next 3 years. And I think the reason for that is, in theory, everybody likes what the Fed has done if you're a congressional, representative, because it's all kicking the can down the road, which normally is good for you to, win your next election. But the difference here is inflation, and inflation has trickled into, we'll call it everyday conversation. And they're going to be strung up by Congress because they got to point a finger at somebody that's not them. And the best way to eventually execute that is to create, congressional committee to review the Fed's tools and reduce their flexibility in using those tools. So I would say that's my quote.
So that means like no more buying junk bond ETFs?
I think the path they will go is, yes, they constrict the list of securities they can buy. And just because they have so much fun with it, add some sort of debt ceiling type of effect to what their total amount they're allotted to buy. So that'd be my hot take, is the Fed will actually have reduced influence over the next 3 years in all of our lives, because Congress is going to take a lot of their powers away because they got to point at somebody.
I do like that. Is a good one, because everyone else is saying like, no, they're just going to keep expanding powers and buying outright stocks. They're going to own half of Apple's market cap, yada, yada, yada. I love it. All right, Devin.
Yeah, I mean, I'd go back to kind of my opening comments about the founding of the firm. I think a lot of the derivative management space just is getting it wrong in that tax matters. You can't bring your institutional thinking into the family office and retail world. You've got to bite the bullet and make the investments to be able to manage derivative overlays in an unfunded multi-custodial environment. It's really tough, and you got to make the investment in order to do it. But once you've swallowed that pill, the opportunity set for the manager is huge, for the investor is huge, and if you use these tools correctly, you actually do stand to get the full benefits of derivative investing rather than kind of small chunks that the managers essentially be able to offer to you.
I love it. And I got to do a shout out and just ask you one question about, you're a semi-pro shooter. Is that correct? You do competitions? I
am, yes.
What does that look like? You're shooting clays or discs or the little targets like in the biathlon and the Olympics?
Yeah. So my particular version of the game is not an Olympic sport. In the Olympics, if you're used to seeing things like bunker trap and international skeet, those are what we call fixed field games where the targets are the same every time. And the discipline that I concentrate on, called sporting clays, and then there's some related sporting clays disciplines. We're looking at the targets for the first time right before you shoot them. So ranges are like, let's call it 10 to 60 yards. Usually in pairs, and kind of any trajectory and speed that people can get to come out of a machine. And the complexity is super high because you've got to be able to look at it, select a technique, make a plan, and then kind of have the confidence to be able to pull it off. It's an endlessly fascinating, difficult, really, really difficult game that's it's exciting, and I've been successful with.
And what are the top guys doing? Like 80%, 90% hit rate?
So scores are far less standard due to the variable difficulty of the game. I mean, even as complex as the game has become, people are very, very good. So, it used to be in sporting clays 15 years ago that you could win the nationals with, a low 90s type score. Now we're talking about needing just out of 300 targets, you probably can miss 8.
Whoa.
So yeah, so we're talking really high 90s averages to be able to win consistently. at a regional and national level.
I
So
love it.
it's very, very competitive. And there's no, and ideally there's no money in it either. So after you spend your life getting good at this, you don't really win anything.
You get a little pat on the back, maybe a plaque.
It's entirely about mental discipline and focus and being able to control yourself well enough to execute.
That's one of my favorite Winter Olympic events, that biathlon, where they're breathing hard, they have to slow it down, hit those targets. And Zed, baby number 2, is it on the way?
Baby number 2.
Baby number 2 on the way. Good luck with that. I tell all expecting parents it's a lot of fun 40% of the time.
That's right. And as to go full circle, it's the end of the Zeds. So first one's a daughter, and the second one's also a girl. So it's ending at 4.
Well, you never know. Zed 5, number 3.
Is there a feminine Zed? I don't
necessarily think it's a masculine name either.
Feminine derivative. We had to work.
Zadina. All right, guys. Thanks. Next time we got to do this in person in Chicago. Devin, you got to come in. But we'll talk to you soon. Good luck with everything, and thanks for being here.
You bet. Thanks, Jeff.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts, and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.